Aloha, I'm Stephen Bondsmith. In this UHERO Focus video, I'll share our third quarter outlook for the Hawaii economy. So far this year, we've seen little reason for optimism. Federal policy changes, including new tariffs, deportations, tighter immigration rules, and federal job cuts, along with related legal challenges, have created significant uncertainty that weighed on the outlook. And now the data is starting to bear that out. So let's start with the broader picture. Over the past few years, the US economy appeared to defy expectations, staying resilient even as interest rates rose. This chart shows the number of jobs created each month in the US in 2024 and 2025. A strong 2024 supported domestic tourism, while international arrivals remained weak. But 2025 hasn't carried that momentum forward. Job growth has slowed, and the last few months show clear signs of strain. But as more data comes in, the job numbers are constantly revised. This chart shows the updated job growth numbers, and the revised numbers now show that the national economy is much weaker than previously thought. Job growth has stalled in most sectors outside of healthcare, and much of that slowdown reflects growing uncertainty. And right now, the biggest uncertainty is still from tariffs. The tariffs rates seem to change from one week to the next, and tariff deals lack the certainty of traditional trade deals like the USMCA. The legality of the tariffs adds another layer of uncertainty, with the issue now headed to the Supreme Court. So if you're a business owner or an investor, you don't know what tariff policy is going to look like a year from now, let alone 5. And when facing this kind of uncertainty, the natural response is often to wait. But that waiting also slows the economy. Tariffs put the Federal Reserve in a tough spot too. The Federal Reserve has affirmed its commitment to both employment and price stability. But tariffs push prices up even as the economy slows, making it harder for the Fed to know whether and when to cut interest rates. And that adds another layer of uncertainty. So while the US economy falters and key international markets are also weakening, Canada is sliding into a recession as its exports are hit by tariffs, and Japan's recovery is slowing after rising inflation prompted its first interest rate hike in years. Canada and Japan are now equally important markets for Hawaii, because the number of tourists from Japan never fully recovered from the pandemic. Japanese visitor numbers remain stuck at less than half their 2019 level, but Canadian arrivals are now falling, down 9% this year, in part due to Canada's tariff-induced recession. Combined with weakening US visitor numbers, this meant Hawaii faced a soft summer. This chart shows real tourism spending each month, seasonally adjusted to allow us to compare spending over time. But the significant decline since spring implies that spending is now about as weak as it was immediately after the Maui wildfires. The wildfires caused a sharp local drop on Maui, and in comparison, this summer's downturn has been more gradual and affects all of the islands. But the comparison to the decline after the wildfires shows the considerable weakness. Maui in particular continues to struggle. 2 years after the fires, tourist numbers on Maui are still about 20% below their pre-fire levels. Looking ahead, we expect statewide tourism to recover only slowly, with visitor counts not returning to post-pandemic highs until 2029. Construction remains the brightest sector in Hawaii. Federal and public investments are sustaining further growth, and construction jobs are expected to peak near 41,000 in 2026, with elevated activity continuing through to the end of the decade. But this construction boom is also facing cost increases for building materials, including specific tariffs on steel. And otherwise, the weak summer in tourism and federal job cuts have wiped out the other job gains in Hawaii, with overall job growth now stalling this year. This is in sharp contrast to the steady, though slow recovery from the pandemic over the last few years. But these declines will expand and widen to other sectors. Federal workers who took deferred resignations were still paid until this month, and so they aren't included in the job loss numbers yet. We're now forecasting the loss of about 4,500 jobs in Hawaii through to the end of 2026. And at the same time, tariff-induced price increases will weigh on household budgets. So where does that leave us? Looking at recent and forecast economic growth suggests that the Hawaii economy is stalling. Construction provided a boost, but that's being offset by the weakening tourism sector and cuts to federal jobs. Looking ahead, further softening of the US and global economies is expected to push Hawaii into a mild recession in 2026. Annual growth will remain barely positive, but we expect 2 quarters of modest decline. Over the longer term, Hawaii returns to its slow long-run growth rate, and this presents a broader problem for the Hawaii economy: the growing gap between Hawaii's economic outcomes and the continent. I'll have more to say about that in my next UHERO report, so keep an eye out for that, and you can find our full forecast at uhero.hawaii.edu. Take care, and mahalo for watching.